Hi, welcome back for day 4 of the Market Volatility Survival Guide. Today is Thursday, March 26th, and today our topic is the rebalancing surge. As I promised yesterday, I'm going to tell you about one of the most powerful forces influencing the stock market right now, and would explain why we're experiencing the third back-to-back day of gains. We're coming up to the end of March and also the end of the first quarter. And what's going on throughout the institutional investment world is that managers of things like pension funds, both corporate and private, and also big endowment funds, managers of target date retirement funds that hold over $1 trillion of assets for individual investors, are buying stocks. Why? Because they have very specific asset allocation guidelines that they're going to adhere to. For example, if your fund calls for a 60% stock, 40% bond allocation, with the stock market sell-off, that stock allocation may be down now to about 50%. So managers are buying stocks to bring that asset allocation back up to that target level. I saw an interview this morning with the Chief Investment Officer of LACERA, the LA County Employees Retirement Association. He was talking about their rebalancing methodology and how they do it on a daily basis. Some managers do a monthly rebalancing process, some do quarterly, but for sure, managers are being forced to buy back stocks at these lower levels, bringing the stock market back up. I also want to tell you that it's important to understand that we don't expect to see a just V-shaped recovery of the sell-off with the stock market going to new all-time highs. I saw another great interview with Paul Tudor Jones, one of the best hedge fund managers of all time, and he said 3 or 4 months from now, I feel really confident the market's going to be higher, but this is going to be a bottoming process probably over the next couple of months. Also, in my own work as a technical analyst, we study the fact that the market tends to move in periods of waves. We are approaching what we call a level of possible resistance for the S&P, where it might kind of plateau and then turn lower from there, possibly going to a new lower level than we saw last week. That level that I'm watching right now is around 2,600 to 2,650. In fact, this morning, the S&P 500 did touch 2,600. To confirm this, I also reached out to a great friend of mine, Carolyn Boridan, who's one of the top technical analysts in the industry. In fact, if you are a regular watcher of Jim Cramer's show, Mad Money on CNBC, you will notice he constantly quotes Carolyn Boridan's work. She also said, Brad, yes, 2,600 could be a possible level of resistance. The message in all of this is long-term, stocks going higher, but we don't want clients to get antsy and feel like they've got to take all the money sitting on the sidelines and throw it into the market right now. The most prudent approach to take is a very measured but gradual one, dollar cost averaging into the market over a period of time to take advantage of the fact that prices may head lower in the near term before ultimately going higher. With that, I want to thank you for following me today. Tomorrow we'll be back talking about some very specific steps we've been taking in our client portfolios and some prudent guidelines for you to follow. Thanks again.